While the content of this video has been reviewed by a certified student loan professional, it is for educational purposes only. Please take a moment to read the disclaimer. Now, on to the video. In our previous videos, we explored the two main strategies to pay off federal student loans. Those two strategies were pay it off and minimize interest, or pay as little as possible and pursue forgiveness. To minimize interest, you may want to refinance, and to pursue forgiveness, you enroll in an income-driven repayment plan. Remember that forgiveness means that under certain conditions, you do not have to pay back the entirety of your federal student loans. However, there is a less commonly used third strategy, where you enroll in an income-driven repayment plan with the intention of paying your loans off. Why would anyone do that? When would this strategy make sense? This strategy may not necessarily maximize savings, but it may provide you with peace of mind, like an insurance product would. Under this strategy, IDR plans are used to provide flexibility for borrowers whose life circumstances may be constantly changing. So, what does that mean and how does it work? If you are not enrolled in an IDR plan, for example, you are enrolled in the standard repayment plan, or you have private or refinanced loans, your monthly payments are locked at a set amount. What if you have variable income? You may be self-employed or work on an hourly or contract basis. Maybe you need to take some unpaid time off because you are looking to grow your family soon. Or you simply want to take some much-needed but unpaid vacation time to travel in the near future. It's also possible that you think you could switch jobs to qualify for public service loan forgiveness because you work as a healthcare professional, where there are a lot of employment opportunities in the public sector. More than half of hospitals in the US are nonprofit and qualify for PSLF employment. Let's look at a situation with $250,000 worth of federal loans again. If the loans are kept in the federal system and enrolled in the default standard 10-year repayment plan at a 6% interest rate, you are required to pay $2,776 per month for 10 years. Now, let's look at an optometrist named Olivia and her situation. She has $250,000 of federal loans from optometry school with an average interest rate of 6%. She makes $100,000 annually working at a private practice. Her spouse also makes $100,000 and they plan to have kids soon. When they start having kids, Olivia wants the option to stop working for a couple of years. If she was on the standard plan, she would still need to pay $2,776 per month. Could she pursue forgiveness? She wouldn't qualify for PSLF because of her employment. She could potentially pursue long-term forgiveness under an IDR plan, but she wants to pay the loans off as fast as possible at her own pace because she really does not like the idea of holding her large student loan debt for up to 25 years, although that may lead to forgiveness. So, Olivia decides to pursue the third strategy, which is the topic of this video. If she is enrolled in SAVE, for example, she can choose to pay the standard repayment amount of $2,776 if she wants to pay the loan off in 10 years. However, if she decides to totally stop working and file taxes separately from her spouse, her monthly payments can be $0. If she decides to work part-time and makes $50,000 a year and files her taxes separately from her spouse, her payments are now $143 per month. And if she were to make $100,000 again, she can stay on the SAVE plan and her required monthly payments would only be $560 if she continues to file her taxes separately. Now, remember that Olivia's goal is to pay off her loans as fast as possible. If she only paid the minimum requirement payments under IDR, she would have to hold the loans for up to 25 years. What's neat about IDR plans is that she can pay more than her monthly required payments, so she can stay on the SAVE plan, which allows her to have the flexibility to pay off her loans at her own pace. This may not be the most cost-efficient strategy if Olivia later decides to pursue forgiveness, because to save the maximum amount of money for forgiveness, she would want to pay as little as possible from the get-go. Also, there is no payment cap in Save, so if she had a large windfall one year, her monthly payment could be more than the standard $2,776. All that being said, this strategy allows Olivia to pay off her loans without locking in a monthly rate, and gives her the peace of mind since she's unsure about her future income situation. Student loans can be super complicated. Always consult with a financial advisor who specializes in student loan planning, such as a certified student loan professional, who can provide personalized guidance based on your specific circumstances. Thank you for watching. Make sure to like, share, and subscribe.